What if I told you some of the biggest corporations in the world make billions of dollars in profit and still pay almost nothing in taxes? Sounds illegal, right? But here's the reality. Companies like Amazon, Apple, and Google have all, at different times, legally reduced their tax bills to surprisingly low levels. In some cases, they have paid a lower percentage in taxes than small businesses or even individual workers. Now pause for a second and think about your own situation. If you have a job, your taxes are deducted before you even see your salary. There is no strategy involved. There is no flexibility. The system is simple. You earn, and then you pay. But corporations operate very differently. They do not just earn money in one place. They operate across multiple countries, deal in different currencies, and structure their finances in ways that most people never get to see. And within that complexity lies opportunity. So the real question is not whether these corporations are breaking the law. The real question is how they are using the law to their advantage. How can a company generate billions in revenue, dominate industries, and still report very little taxable profit? How can profits seem to disappear on paper, even when the business is clearly thriving? And why do governments allow these practices to continue? The answer is both simple and complicated. At the same time, the system is built with rules, and those rules, when understood deeply, create legal pathways that corporations can use to reduce what they owe. This is not about secret tricks hidden in the shadows. This is about understanding how the financial system is designed, because once you understand this, something shifts in your thinking. You stop seeing taxes as just a fixed cost of earning money. You start seeing them as something that can be managed, reduced, and strategically planned. And here is the most important part. While you may not run a billion-dollar corporation, the principles behind these strategies are not exclusive to the ultra-rich. They are rooted in how money flows, how businesses are structured, and how assets are managed. So in this video, we are going to break it all down in a simple and clear way. No complex legal language, no confusing technical terms, just a real understanding of how corporations avoid taxes, why it is often completely legal, and what you can learn from it. Because once you see how the system actually works, you will never look at money the same way again. Most people believe taxes are simple. You earn money, and then you pay a percentage of it to the government. That is how it works for employees, freelancers, and small business owners. The more you earn, the more you pay. It feels fair, predictable, and unavoidable, and because this is the system most people experience, they assume it applies to everyone equally. But that assumption is where the misunderstanding begins. The reality is that corporations do not pay taxes based on how much money they make. They pay taxes based on how much profit they report, and those two things are very different. Revenue is the total money a company brings in. Profit is what remains after expenses, deductions, and adjustments. And here is where things get interesting. Corporations have a huge amount of control over what counts as an expense. They can deduct costs like salaries, research, marketing, infrastructure, and even future investments. The more they classify as expenses, the lower their reported profit becomes. And the lower their profit, the less tax they owe. So while the public sees a company generating billions, the tax system might see a company making very little profit at all. This creates a gap between perception and reality. People look at companies like Amazon and think, this company must be paying massive taxes. But in reality, there have been years where its tax bill was surprisingly low compared to its size. That is when frustration starts to build. People begin to think the system is broken, or worse, that corporations are cheating. But here's the truth that most people miss. In many cases, these corporations are not breaking any laws at all. They are simply using the rules differently. The tax system is not just a payment system. It is also a policy tool. Governments design tax laws to encourage certain behaviors, like investing in innovation, creating jobs, or expanding globally, and corporations respond to those incentives. They hire experts, accountants, and legal teams, whose entire job is to understand every detail of the tax code. Their goal is simple: reduce the company's tax burden as much as legally possible. Meanwhile, the average person never learns how the system actually works. They follow the default path: earn income, pay taxes, repeat, and that is the real problem. It is not just that corporations pay less tax. It is that most people do not understand why. Because once you understand the difference between income and profit, and how expenses can be structured, you begin to see that taxes are not just about earning more. They are about how you structure what you earn. And that realization changes everything. So how do corporations actually reduce their taxes? It all comes down to one simple idea. They do not focus on how much money they make. They focus on how much profit they show, and to control profit, they control three main things: expenses, location, and timing. Let's start with expenses. Corporations can deduct a wide range of costs before calculating profit. This includes salaries, rent, technology, logistics, research, and even future investments. If a company earns $1 billion but spends $900 million on operations and expansion, it is only taxed on the remaining $100 million. Now here is where it gets strategic. Companies often choose to reinvest heavily into their own growth. Instead of showing large profits, they pour money back into the business. This reduces their taxable income while also helping them grow faster. This is one of the key reasons companies like Amazon reported low profits for years despite massive revenues. They were constantly reinvesting. Next is location. Large corporations operate globally. This means they can choose where their profits are recorded. Some countries have lower corporate tax rates, often called tax havens. So what do companies do? They set up subsidiaries in these low-tax countries. Then, through legal accounting methods, they shift profits from high-tax countries to low-tax ones. For example, a company like Apple has historically structured parts of its business through countries with favorable tax policies. This allows them to reduce the overall tax they pay worldwide. It sounds complex, but the idea is simple. Earn globally, report strategically. The third factor is timing. Corporations can decide when to recognize income and when to take deductions. By delaying income or accelerating expenses, they can reduce taxes in a given year. Think of it like this: if you know you're going to have a high tax bill this year, you might choose to invest more now so your profit appears lower. Corporations do this on a much larger scale. And then there are tax credits. Governments offer incentives for specific activities like research, clean energy, or infrastructure development. Companies take full advantage of these credits to directly reduce what they owe. Companies like Tesla have benefited from such incentives while scaling rapidly. So when you combine all these strategies, something powerful happens. A company can generate billions in revenue, grow aggressively, expand globally, and still legally minimize its tax burden. And that is the key word here: legally. These are not hidden tricks. These are built into the system. Corporations simply understand the rules deeply and use them to their advantage. And once you see this clearly, you start to realize that taxes are not just about income. They are about strategy. Let's look at how this works in the real world by examining one of the most talked about examples in modern finance. A major case often discussed is Amazon. Over the years, Amazon has reported massive revenues from its global operations. Yet, in several years, its federal tax bill in the United States has been surprisingly low compared to its size. So how did this happen? First, Amazon aggressively reinvested its profits back into the business. Instead of holding onto earnings, the company spent heavily on expanding warehouses, logistics networks, technology infrastructure, and new services. These investments are considered expenses, and as you learned earlier, expenses reduce taxable profit. So even though the company was generating billions, a large portion of that money was being reinvested rather than shown as profit on paper. Second, Amazon benefited from tax credits and deductions available for investments in infrastructure, job creation, and research. Governments often provide these incentives to encourage business growth and economic development. Amazon took full advantage of these programs. Third, like many global corporations, Amazon operates across multiple regions. This allows the company to structure its earnings in ways that align with different tax systems. While the details are complex, the principle is simple. Profits can be allocated in a way that minimizes overall taxation. Now let's compare this to individuals. If you earn a salary, you do not have many options. Your income is taxed directly. You cannot deduct your daily living expenses like rent or groceries to reduce your taxable salary in a meaningful way. But corporations operate differently. They are allowed to deduct business-related expenses, reinvest earnings, and use financial structures that are not available to individuals. This is why companies like Apple have also been able to significantly reduce their tax bills in certain years. Apple, for example, has used global operations and financial structuring to manage its taxable income across different regions. Another example is Tesla, which has benefited from government incentives tied to clean energy. These incentives can directly reduce the amount of taxes owed. sometimes by hundreds of millions. What all these examples show is not just clever accounting, they show a system that is designed with flexibility. Corporations study these rules carefully. They build teams of experts whose job is to understand tax laws in different countries and find legal ways to reduce costs. And the result is a financial system where the companies with the same revenue can end up paying very different amounts in taxes, depending on how they operate. This is not luck.it's strategy, and once you see these patterns, you begin to understand why the richest companies in the world do not just focus on earning more, they focus on structuring everything around what they earn. So what should you take away from all of this? The biggest lesson is that the financial system rewards understanding, not just effort. Most people think the path to wealth is simple. Earn more money, work harder, and you will get ahead. But corporations operate on a different principle. They focus on how money flows, not just how much money comes in. They understand that income is only one part of the equation. The real game is how that income is structured, managed, and protected. This is why companies like Apple and Amazon can operate at massive scales while still minimizing taxes. They are not just earning money, they are managing it strategically, and here is where the mindset shift happens. Instead of asking, "How much did I earn?" a more powerful question is, "How is my money being treated?" Because income without structure can disappear quickly through taxes, expenses, and poor financial planning, but income that is managed strategically can grow and compound over time. Corporations think in terms of assets and leverage. An asset is something that generates value over time. A well-structured business, a strong brand, or a scalable system can all be assets. Leverage means using what you have to create more value. This could be through borrowed capital, strategic investments, or efficient systems. When corporations combine assets with leverage, they create growth while controlling costs, and taxes are part of that equation. Instead of treating taxes as a fixed burden, they treat them as something to be planned for. They use legal deductions, reinvestment strategies, and financial structures to optimize what they owe. Now, you do not need to be a corporation to apply this mindset. You can start by thinking differently about your own money. Are you only earning income, or are you building assets? Are you just paying taxes, or are you learning how to manage them efficiently within the legal framework? Do you understand where your money goes after you earn it? These are the questions that separate average financial thinking from advanced financial thinking, and the earlier you start thinking this way, the more control you gain over your financial future. Now that you understand how corporations avoid taxes, you have seen something most people never take the time to learn. But here is the truth. Knowing is not enough. You can watch videos, read articles, and learn concepts like the ones we covered today. But if you do not apply this knowledge, it does not change anything in your life. So if you are serious about improving your financial knowledge, building wealth, and understanding the system behind the money, make sure you subscribe to the Geeky Investor, because the more you learn, the more powerful your financial decisions become. And in today's world, that knowledge can make all the difference.